in the enterprise space, there may be, that is where probably, the more action could be, where enterprises would like to have access to, network all the time, and they don't mind paying a bit of premium as long as the security aspects and all are, taken care of. So that is how I see it.
So Balaji, 30 seconds market, we're hitting market opening. Basically, is this a potential threat averted? I mean, for Jio and for Bharti, what is the net takeaway? Is it absolutely neutral? Is it positive because now there is no overhang of competing with Elon Musk? What's the final take?
So in the near term, it is going to be neutral. And I think the very fact that they are tying up means that, at least some investors had a worry that this is going to be a disruption. At least, that disruption risk kind of, that overhang goes away, because even though the telcos were telling that there is no risk of disruption, but, I think actions speak a lot louder than words.
Right, thank you very much for making sense of this big development for us. We'll watch out for how telecom stocks open up.
Okay. All right. Well, we've got stock of the market then. First rates coming in there. The Nifty puts on a half a century. That's great news. 50 points higher after ending yesterday at the high point of the day. So good going out there. What's gaining? Bharti Airtel. That's up close to around 1.5%. Reliance Industries, the big boy in there. That's up close to around 1%. So both those two posts that Starlink, tie-up, both of them are higher. Good going on that front. Power Grid, that's up close to around 1.5%. And BPCL, the decline that we saw around crude oil prices is working well. I think Avendis as well has come out with the note. They have upgraded HPCL, upgraded IOC, and they maintain their buy rating on BPCL. So those stocks are doing quite well. What's not doing well? IndusInd Bank. After yesterday's, 27% cut, it's down another 4% or thereabouts. So that stock is taking a hard knock. And I think there's a downgrade that's come in from Motilal Oswal on some of these tech-related names. And some of them are reacting. HCL Tech is down close to 100%. Infosys is down close to 100% or thereabouts. By the way, keep an eye out on Bharti Airtel. That's putting on good weight now. It's up 2.5%. So that's clearly the leader this morning, holding one end up. And the breadth of the market actually is very, very good as we speak. You have close to around 4 stocks that are advancing for 1 stock that's declining. And from the broader markets, BPCL was doing well from the Nifty. HPCL is the big move on the broader markets. BSE has bounced back. It corrected from 6,000 rupees to around 4,000 rupees. Well, today it's pulling back. And PP Fintech, so-called value unlocking, Street hasn't read it positively because they're putting more than 600 crores thereabouts, in that project, that healthcare project that they're talking about. So 2.5% lower on that one.
Okay, so it started off with a flare, and now it's becoming a little quiet, especially the mid-cap index. At one point in time, it was up 0.5%. Now it's about 0.2% higher. Let's take a look at some of the key gainers beyond the Nifty as well. So we talk about some of the big movers. There is Senco that's trying to put on a little bit of weight. There's HPCL, which continues to move higher, about 3% up on HPCL as well. These are some of the names that are coming up early on the screen. Let's also take stock of, IndusInd Bank and see what this one's doing. Look at IndusInd Bank, 5.5% down after a 27% decline yesterday. There's just no let up. And a lot of the literature that's been doing the rounds, reports, etc., murmurs. I mean, despite the clarification from Mr. Katalia, clearly the market's still very, very nervous. Aside of that, all of large cap IT is still falling. Infosys, Wipro, HCL Tech, TCS, all of these stocks down. So IndusInd Bank and IT, these are the big drags on the index. And Lever is the other one, which is lower. Aside of IndusInd, by the way, the other banks have managed to pull up smartly. HDFC Bank, for instance, is in pole position, 1% higher, looking fairly okay. SBI is also up and about. Reliance is contributing on the upside. And now again, there's a bit of volatility. Again, look at the indices. Nifty is now 66 points higher, cruising along nicely. And the mid-cap index up 0.5% again.
Well, just to elaborate a little bit more on the technology names and the cut that we're seeing. So Motilal Oswal has come out with a note, and they're saying that the street was expecting FY26 growth to rebound because discretionary spending was cut in FY23-24, and now things are improving. Now in the coming year, growth will rebound. But now they're saying that given the uncertainty surrounding the entire tariff, sentiment has been hit. They no longer expect discretionary spend rebound in FY26. Companies, so therefore they have lowered the growth assessment quite meaningfully. So for TCS in FY26, they were earlier anticipating a 6% kind of growth. They brought it down to 3.5%. For Infi, From 7.5%, growth is now seen at 5%. From Wipro, from +4, it's now down to, just 2.9%. For HCL Tech, from 6.6% down to 5.3%. So basically, growth estimates across the technology pack have been brought down significantly for FY26 and FY27 because the sentiment, according to them, has turned cautious from January to March. Enterprises are now adopting a wait-and-watch approach when it comes to discretionary spending. So growth estimates have been slashed. One more stock, Keynes Technology. That's the one which is plunged after MD has received a show cause notice from SEBI. I'm just trying to find out what the reason for the SEBI.
So
this is violations in maintaining the structured digital database.
SDD.
SDD, relating to the company's financial results for the period ending FY23-24. So big fall in Keynes Technology, and that one stands out on the mid-cap.
Just one point, what a lot of the sales notes are saying, that this is a show cause notice. It's not a conviction of any kind of wrongdoing as well. For the time being, the street is not taking it lightly. Stock at the low point of the day, down 8%.
Okay, all right. So that's Keynes, another casualty of some issues with respect to regulatory misses, down 8.5% right now. Market overall has stabilized. Final tally as the opening settles is about 28 to 30 points higher on the Nifty, with the mid-caps doing a shade better. Time now to move on to our special conversation, Market Masters. Today we have with us the Citi India top team. Surendra Goyal, Head of India Research, Samiran Chakrabarti, Chief Economist, India, and Kunal Shah, Director, India Bank's Financials. Gentlemen, great to have all of you with us. Thank you so much for joining in. I could start with the banks question because that's become the hottest topic in the last, 48 hours. But we'll come to that. We'll come to banks in just a bit. Surendra, let's open with you because looking at some of your latest notes, it's quite evident that you folks have turned a little positive on the market and you're finding valuations also more palatable. So let's start there. Where does India stand now after this 5-month-old correction?
Sure. Thanks for having us on the show. Yes, we have turned more positive on India. Around a couple of weeks back, we turned overweight on India in our within our EM strategy framework. And there are a bunch of reasons driving that view. Firstly, growth did slow down, but we believe it's a cyclical slowdown and we should see improvement going forward. We have already seen certain actions by the RBI, government, etc., which gives us more confidence on the growth outlook improvement going forward. Of course, these things do take some time to reflect. So it will take time, but the outlook seems to be improving. From a EM perspective, what we noted in our US marketing trip as well, and even our regional data seems to support it, is that EM funds in general are underweight on India. And our regional team does this analysis on a monthly basis. And EM funds that we track within that study, they are around 150 basis points underweight on India, right? And if you look at the last 20 odd years, India has mostly been an overweight. And even if it has gone to underweight, it has been very briefly a few times. So that setup also is more favorable. On valuations, we have seen the market pulling back, like it had gone to highs of Nifty 22, 23 times earnings at the peak. Now it's kind of come down to 18.5, 19 times. So that looks a lot better as well from a valuation standpoint. And then finally, from a flow perspective, we have seen a fair amount of outflows since October. But the outflows on FII side seem to be slowing down. And so far, the domestic flows have been pretty resilient. So when you kind of put everything together, there has been a valuation correction. We believe growth should see pick up as we go forward. And the setup from a positioning perspective is also favorable. So that's the reason why we are increasingly, we have turned more positive on the market. And we recently changed our stance to overweight within our EM strategy.
So Surendra, just to continue that point, you're overweight India. So if someone has to buy Indian stocks or give us the way you would construct your portfolio, what are the sectors that you like and which ones would you avoid now?
Yeah, sure. So what, like in terms of sectoral overweights and underweights, where we are overweight today, firstly is financial services, where we think that things are kind of gradually starting to improve. And again, it's a modest improvement, but it's not getting worse. And valuations in the context of the market or in the context of history are quite attractive. And again, we are more positive on the larger names in that space. That's the first pocket. Secondly, there are a couple of sectors where there is good earnings visibility, be it the telecom players or the domestic healthcare space. So those are again another space or other spaces that we like. And then we have cement, where we turned positive a couple of months back or maybe 3 months back. So there again, our view was that things should improve, should pick up from here. And last year was a weak year. So stocks had corrected. So yeah, those are some of the sectors. And then beyond that, there are some specific themes also that we like. Like, for example, travel is one space where we think the domestic travel market is quite strong. And there are plays on that which should continue to do well going forward. Overall, like IT services and consumption in general, beyond a few pockets, those are the two sectors where we still have a relatively more cautious view. So that's how we are positioned right now.
All right. Good morning, gentlemen, and good to have you all on the show. Well, Surendra, let's push a couple of those points a little ahead then. You're broadly focused on the domestic themes. Cement, as you said, the healthcare space as well as what you're looking at. Let's, focus on a couple of things that you said. One is the rotation trade, the money moving to China, and China has done a relative outperformance in the last 6 to around 8 months. Bulk of that rotation trade, is it done? And since FIs have been, underweight on emerging markets on the whole, do you think it makes a strong case for them to come back? And should we see this big outflow gradually start reversing in the months to come in 2025?
Sure. So see, there are a few variables here to keep in mind. Like if you look at the dollar had gone from, say, DXY had gone from 100 odd levels to 108, 109 levels a month back or so. And from there, it's kind of retraced back to 103, 104, which is usually relatively better from a EM perspective. So that's something I would watch out for. And we have seen kind of outflows kind of slow down very meaningfully in the recent past. So again, we are monitoring trends, but overall it does look that at least things are not as tough from a foreign flow perspective as they were in October, November, December. So that's something to watch out for. Secondly, on the other part of your question, China versus India, again, obviously China, if you look at MSCI China this calendar year, there is a 20% outperformance versus India. And a lot of that has to do with the Chinese technology stocks, right? If you look at the tech index there, it has outperformed the broader market there by another 10 to 15%. So it is a tech-driven rally. So when we talk to clients, I think the market, Chinese market from a valuation perspective was obviously low in the historical context. So there is interest. But I think from an India perspective, what is really required is the visibility of a growth pickup. For a lot of investors we talk to, India continues to be a secular play within the EM space. Valuations had gone higher. And there was a cyclical slowdown, and that is what resulted in people taking off money from India, even within the EM framework. So I think that is what really needs to be visible, the growth pickup, for people to be more interested in the Indian market.
Okay, all right. Another level that we look at, the Nifty, well, we have come down from around that 26,500 or closer to around 22,500. What's the year-end target on the Nifty itself, given that earnings should come back, CapEx spends are picking up, the RBI is injecting liquidity as well? What's the level we should be working with for the next 12 months?
Sure. So we have a published target of 26,000 on the Nifty, which is like, say, 15-16% upside from current levels.
Okay. All right. So still looking at 26,000, perhaps by the end of the calendar year. Got that, Surendra. Let me come to, Samiran for a couple of questions. We're talking about this growth slowdown. Samiran, so, where do you think we're heading next? Because now we have a turbocharged RBI. I think your own models talk of 2 rate cuts somewhere in the middle of this year, 25 basis points, 2 rate cuts. There's this big liquidity bonanza just today. This big OMO is happening. So you think that will sufficiently propel us forward to meet our targets? I don't know. A lot of people say the fourth quarter sort of asking rate is too high. We'll have to grow at 7.5% to meet the full year targets for FY25. But given the pace at which the RBI is moving now, what do you think about growth prospects for the next year?
So from a policymaker's perspective, there are two different tracks that they're working on. On the fiscal policy side, we have seen a personal income tax cut, which is worth about 30 basis points of GDP. And from the monetary policy side, again, there are different approaches being taken. First is that the exchange rate has been allowed to adjust back from the overvalued levels to a much more fair value level now. Second is that the liquidity easing has been very, very consistent and much stronger than what market expectations have been. Third is the rate cut process has started. And fourth is there has been some relaxation on the macroprudential regulations. Now, this package in itself could be worth about 30 odd basis point of GDP, just from the perspective that 50, 75 basis point of rate cut should bring down the borrower's borrowing cost by that much amount. So 30 basis point of GDP from the fiscal side and 30 basis point of GDP from the monetary policy side could be the immediate boost to the household's purchasing power, so to say. And then if this liquidity finally kicks into higher credit growth with a lag, then that can be another booster to overall growth. So we think that 6.5 to 7 kind of growth for next year is quite doable. Just on a small note, the estimated fourth quarter GDP number is probably not that important a variable to look at, because the first 2 quarters data will get revised as we move into the full year number to be released in May. Once that adjustment happens, then the whole profile of the quarterly numbers could be much more stable.
So, Samiran, hearing you talk about our domestic engines, one feels very, very confident, right? Because the twin engines are firing, both fiscal and monetary. And like you said, 30 plus 30, that's 60 basis points for Philip to GDP straight away. But now we have to superimpose the global uncertainty and this absolutely dizzying, crazy tariff business. And we don't know where the parlays end up finally between India and the US. There's still a negotiation for a trade deal, so we don't know what the final numbers will look like. But even if we go with absolute reciprocal tariffs, what's the hit that will have to be perhaps penciled in? And will local growth still more than make up for it?
This is a very complicated exercise with incomplete information, because we just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. There could be, in fact, we think that beyond the tariffs, what is more important is that if India starts purchasing more of US energy and defense, that's a better way to reduce the trade surplus that India has with US. So it's too early to get into a very precise assessment of what the direct impact is going to be. But what we are also worried about is the indirect impact, because this uncertainty, the longer it lasts, it will affect private investment, it will affect markets, it will affect, through a negative wealth effect, the consumer behavior as well.
But Samiran, just to complete this point, in your projection of, I think, 6.6%, right? For FY26, you're at 6.6% GDP growth. What impact, if any, of this tariff issue have you factored in to get to that number of 6.6 for next year?
So at this moment, we have put it more as a risk factor rather than putting it into our baseline.
Okay.
So that's 0.2% of GDP. You can think of that more of as a risk.
All right. Samiran, one more point on the RBI cuts. I think you're factoring in 2 more cuts, right? What if the Fed doesn't move at all? You'll have considered that as well in your model. 2 rate cuts is what we're going to get, irrespective of what happens?
So in fact, we have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India, regardless of what happens in US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
You said 5 Fed rate cuts or 5 rate cuts from RBI?
Fed rate cuts. I mean, we have a view of 5 rate cuts in US this year.
Oh, this year. Okay, got that. That'll be quite the bazooka for the markets. But Kunal Shah, Director, India Bank's Financial at Citi, has also been patiently listening in. Kunal, it's all happening in the banks and it's all happening with Innocent Bank. We know your preferred financials include HDFC Bank and ICICI Bank and a Kotak Mahindra Bank and not an Innocent Bank. But give us your thoughts on what's transpired in Innocent Bank over the last 24 hours, what your conversation with investors are, what are they doing with Innocent Bank? Have they just thrown in the towel now? Share your initial thoughts on the fiasco that's played out.
Yeah, so in terms of the filing, we have seen that there has been discrepancy to the extent of 2.35% of the net worth. And that will be accounted for in 4Q earnings. That's what they indicated in the call. So people are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalya, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters.
But is the stock looking attractive to you after this kind of a fall? And there are some worries that things could go downhill on Twitter, which is not the apt space to get your opinion in. But there are comparisons of fears being drawn. Will it be similar to, say, a Yes Bank? So what would you advise doing with Innocent Bank shares now?
So there are near-term uncertainties. There is an overhang which is there, both with respect to the earnings as well as on the succession, as I was indicating. But in terms of the valuations, again, when we look at it, it's closer to like 0.6 times multiple. And that's where, so maybe near-term, definitely we could see some kind of an uncertainty being there in the stock. But valuations, when you look at it, that has also come off and it's factoring in those kind of a risk currently, yeah.
All right, the market cap sub 50,000 crores for a business size of more than 7.5 lakh crore. Abhishek, our banking expert tells us that as well. So interesting to see how that pans out. But Kunal, what about for the banking, the credit growth itself? What are you factoring in? There was a bit of a scare a few months ago when it came down, I think, to around 10-11% or thereabouts. What are you factoring in for the coming year for the credit growth for the industry itself?
So we are looking at, we will see some kind of a boost to the extent of 1 or 2 percentage points in the credit growth from where it is currently. And as Samiran was indicating, now we have seen the liquidity injection. There will be some push towards the retail credit post this entire decrease in the tax rates. And in fact, RBI has also restored risk weights on a couple of business segments. So NBFC credit and when we look at it, unsecured credit was something which was driving down the credit growth over past 6-7 months. Maybe some normalization over there could also help boost it. And along with that, some pickup on the corporate credit side, which is still in the range of 6 to 7 odd %. We should see some upside as the investments kick in. So all 3 vectors, maybe I would say the retail credit, RBI's risk weight decrease, as well as some inch up on the corporate credit side should help take credit growth towards 13 odd %.
Okay, Kunal, what about the big call you made in the recent past, last couple of weeks, everyone was looking at stocks that have corrected and valuation-wise have become fairly okay. And SBI was one such name. Did a big change of stance on that one. Tell us more about that. Valuations comfortable, decent return ratios, and you have credit growth as well. That's the big call, right?
Yeah, so overall PSU banks, when we look at it, valuations have come off a bit, and we will see them getting the benefit on the credit growth side as well. And credit cost, when we are looking at for the PSU banks, that has been relatively low compared to their historical past. So all that is helping them in terms of sustaining the ROAs for PSU banks.
Surendra, I want to come back to the headline point that you made on FPI selling and the fact that the positioning is at now multi-decadal low, not even multi-year low. Aside of the fact that obviously this is tactical positioning, right? I mean, whether it was the home market bias, whether it was some tactical quick shifts to China, which one understands. Aside of that, is there anything else that FPIs have sort of had an issue with in India? There's been some murmur on taxation, for instance. We also hear some murmurs about how registering in India is very time-consuming and difficult. But I don't know, maybe these murmurs also come through when a market is falling. In a rising market, you don't hear them. But what's your sense? Any other issues that are bothering FPIs?
Yeah, so I think I just add the point there that India's weightage in the EM indices has also gone up substantially. Okay, so say 5-6 years back, India's weightage used to be 8-9%, today it's 17% or so. So the weightage of India has gone up substantially, so that also kind of needs to be kept in mind. On the other points that you mentioned, again, I don't think a lot has changed in the last 3-4 months. Okay, so to that extent, I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective, right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. If you see where the market pulled back and where FI flows happened, one of the things was the cyclical slowdown, right? But the fact is FY25 earnings have seen a moderation versus the start of the year expectation of Nifty delivering low double-digit growth will possibly end up with mid-single-digit growth. So to me, earnings moderation was one of the reasons, in addition to the stronger dollar and then later on China bouncing back. I think a lot of things came together, but the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India.
I absolutely agree with you. At the end of the day, I mean, earnings speak for themselves, and at times they can speak the loudest in the room. Speaking of which, for FY25 is over, like you're saying, it's been a disappointing year, right? Maybe we'll get 6-7% at max. FY26, what's the growth that you're penciling in? And the larger question, do you believe this market can still keep compounding earnings at, say, 12 to 15% every year?
Yeah. So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year, FY26. And again, the drivers, again, Samiran kind of spoke about the view on GDP. And we should see an improvement pretty much across quite a few sectors. So to that extent, that's what is really required. You need to see the visibility of earnings kind of getting to that number. We have been in an environment last few quarters where earnings have been revised down. So I think stability in the earnings outlook is the first thing we would watch out for. So that, I think, that number staying at low to mid-teens, I think that is what is really required for the market to find support and start going up from here. Medium term, I think low double-digit growth still possible in our view. Like if you look at nominal GDP growing at 10-11%, which is what the expectations are, then I think a growth which is somewhere in that territory. Of course, it could be volatile year to year, depending on how each of the sectors move. Particularly, commodities do add a fair bit of volatility and so on. But I think that kind of a medium-term compounding is possible. And that's what really makes India attractive from a EM and investors' perspective.
And just to complete that point on financials, which is one of your biggest overweight calls, Surendran, whatever's happened with the IndusInd Bank, say yesterday, or let's talk about the last 1 year, right? There are different regulatory issues with different banks that have cropped up. With Kotak, it was onboarding new customers on the digital platform. HDFC Bank went through its sort of period of regulatory changes and uptick as well. Now, the problem with large banks is that even if you're overweight, even if you have them in your portfolio, they'll not perform till those FPIs return, or at least if they stop selling every day. So then how is the best way to play financials, given the rate cut view that Samiran spoke of? Because with large banks, you're stuck. I mean, you'll always be subject to the vagaries of FPI buying or selling.
So, see, I would kind of highlight a point here that within some of the, and I can't comment on specific names, but within the large banks you mentioned, there are names, or there is a name which has kind of outperformed through this period. Okay, consistency in performance is very important. And I think what we are looking at is a framework of two things. Is the outlook getting better, both from a growth perspective, a regulatory perspective, everything put together, is the outlook getting better at the margin? And secondly, where are valuations in the context of history and in context of the market? That's the broad framework, and all of these parameters, we find the large banks attractive. And I think finally the outperformance will come from consistent business performance, because even the names that you mentioned, if you kind of just go back and look at 1 year, 2 year performance, there is a fairly big divergence, while we tend to categorize them together. So I think consistency in operating performance is what will give you the returns going forward.
Okay, all right. We here in India, we're worried about these FI outflows, which have clocked $28 billion in the last 7 or 8 months or so. The question is, where are these flows going? Samiran, I believe you've done some work on that. The flows are out of India, and all of a sudden you have the European economy that's bouncing back. China is showing signs they're coming back to life. Where do you see, where are these flows going? Leaving India, FI flows, but going where?
So in general, this is the period where we have seen some new narratives cropping up. There is a US exceptionalism narrative which has brought flows to US. There's a strong dollar narrative which was going on that has taken money out of EM. Now in Europe, there is a narrative of European defense spending and infrastructure spending probably adding more than 1 percentage points of GDP every year for the next 5 years. That's probably dragging money into Europe. Whereas some other parts of the world, like Japan, like in India, we have seen outflows happening because the narrative, there's not been a new narrative. It's not that there's been anything in particular negative about India, but it's just that there have been more attractive narratives elsewhere. Surendra was talking about the China tech being another narrative, which has also drawn interest from investors. I think this is markets. The markets will work on narratives, and at some point of time, different economies will be able to provide those narratives. We just hope that in the Indian context, the growth narrative comes back in FY26, given our expectations of the policy support that has already taken place.
Samiran, finally, since you mentioned Europe, I just want to ask you this, because this is a new game in town, right? First, it was US exceptionalism and the numbers were supporting it. Then there was a lot of the talk of Chinese stimulus, and then you had a tactical China trade. But Europe, like I said, is literally the new game in town. I mean, the amount of money that's pouring into European equities now, and we're seeing what's happening with German bond yields as well, with this whole so-called rearmament exercise. Do you think this is meaningful from near to medium-term point of view, or is this just the market getting excited because we've not seen anything out of Europe in so long?
Yes, at this point of time, it's all about announcements. The next in line would be about trying to find the funding for this. At this moment, most of the funding is coming out of the national budgets rather than any specific fund at a European level for it. So we'll have to see which country has how much space in their budget to do these things. We are already seeing that countries which are closer to Russia are announcing a much larger defense plan compared to the rest of the countries. So that's the second part, which is the funding part. And then the third part would be the execution part on exactly how this money is going to be spent. If Europe just ends up buying or importing these armaments from somewhere else in the world, then it does not add up to the European GDP as much. But if this leads to more production within Europe, then the growth outlook becomes stronger. Our European economists, they think that the near-term growth impact for 2025 or 26 is relatively low, in the range of about 0.2 percentage point of GDP only. But if you move to 2027-28, then the impact could be more meaningful at 0.5 to 0.9% of GDP. In the context of Europe, which anyway grows only about 2% or so, this could be a very meaningful push-up in GDP growth if it actually happens.
That's very, very interesting. That's helpful perspective as well. I mean, really explains why the equity bulls are suddenly rushing and piling into European equities on that hope of that GDP boost coming through. But we hope, of course, that India continues its charting its own growth story as well. Gentlemen, thank you very much. It's been a pleasure having you on the show this morning. Thank you for all the perspective. Well, there you have it. That's the view coming in from the Citi India top team. We have to take a quick break right now. On the other side, we get chatting with Sunil Bohra of Uno Minda, talk about the company's business outlook in the face of a lot of tariff uncertainty.
Welcome back. By the way, Infosys is down close to about 3.5%. It's not just Motilal Oswal which has downgraded Infosys. Even Morgan Stanley has downgraded Infosys to an equal weight, and they've cut the target price to 1740 from 2150. So 2 downgrades on Infosys, and that's putting pressure on the stock. Morgan Stanley too prefers TCS over Infosys. So keep your eye on the tech developments. But let's focus on Tata Motors. That's up more than 2%. Sudarshan joins in.
So Tata Motors is today top Nifty gainer. It's up around 3%. Remember, the stock has been amongst top underperformers if you check the graph of the recent past. And stock was around 52-week lows. It's down 12% in the last 2 to 3 months, basically in 2025. Now, today it's higher because Tata Motors CFO had held analyst meet yesterday, and the commentary that's coming out of that analyst meet is looking largely positive. So first on JLR, company has maintained Q4 EBIT margin guidance of 10%, and the second guidance that has been maintained is to be net debt EBITDA positive by FY25 end. Now talking about geographies, company says that US continues to do well. In China, it's outperforming the industry. In EU, demand is less challenging than what company had expected, and even UK is improving. On domestic front, it says CV margin has been performing as per expectations. One segment that needs an improvement is passenger vehicle segment. And going forward, company's focus would be arrest market share loss, especially in the small CV segment. Now, following that, most of the brokerages have come out with a note, and most of them are largely positive on the stock. Nomura has a buy call, target is 861. Macquarie has an outperform call and target is 826. CLSA has high conviction outperform call and target is 930. GS has neutral call with a target of 690, and Nuvama maintains reduced call and target is 720. So overall, it's looking positive for Tata Motors, at least the commentary that has come out from the analyst meet.
Okay, all right, sir. And, you know, the big positive from an India market perspective as well as economy perspective is the decline we've seen in crude oil prices. That's what's caused OMCs to spike up. Today as well, they're surging. Tell us more.
So if you would have seen in the last few sessions, all these OMCs have been gaining except 1 or 2 sessions in the last 5 sessions, these three stocks have gained somewhere in the range of 10 to 15%. Today, these three stocks are higher because Avendus has come out with a note and it has upgraded both HPCL and IOC and has maintained buy call on BPCL. For HPCL, target is 460, for IOC, target is 155, and for BPCL, target is 400. So it has given three reasons. First, benign valuation. It says valuation is 15 to 25% lower against 10-year average price to book value. Second, crude prices. You would have seen that in the last few days, crude has seen a sharp fall. Brent has come below $70 per barrel, and that's the reason even Avendus is expecting Brent to remain below $75 per barrel. And third is stronger GRM that Avendus is expecting. It's saying that slowdown in refinery additions in CY 25 and 26 points to a revival in GRM, and that would be positive for OMCs. Second, expansion in auto fuel marketing margin and reduction in LPG losses will be a key play in FY26. And last is it sees high chances of H1 FY26 profitability for all the three oil marketing companies to be more than 70% of FY26 estimates that it had earlier. So on the back of this, you are seeing a big move in all three names today.
Thank you very much for that. Moving on now to the auto sector. Domestic auto industry has seen muted growth in the second half of the year. And the question is, will Trump's tariff war impact autos, especially companies with exposure to the European region also? To discuss all this and more, Sunil Bora, Group CFO at Uno Minda, is now with us on the show. Mr. Bora, that's the first question, right? How do tariffs impact you? If you do get any sort of reciprocal tariffs, if you could lay out how you're assessing the impact for you, considering your export exposure, and also European markets were downbeat for you. You've highlighted that in the past. What are we seeing right now in the Jan to March quarter? Have things improved, and what can you guide for FY26?
Yeah, so thanks. In terms of your first question of tariff, so if you see our total revenues, we are largely a domestic company. Almost 89% of our revenues are domestic driven, and roughly around 18% is what we get from our global revenues, which includes operations in ASEAN, in Europe, and we have small plant in Mexico. So overall, if you see of the overall pie, the exports from India is roughly around 4%, 3 to 4% of our total revenue. So as of now, we don't see any significant impact based on whatever discussions we are having with our customers. The exports, whatever we are doing from India for some switches or seats, we are not seeing any material impact as of now, but definitely things are evolving as we speak on a daily basis. So we are keeping a close watch on that. So as of now, we don't foresee any significant impact in the short term. In terms of your second question, which is Europe, in terms of our revenues, definitely things have been sort of stable to, I would say, marginally positive, because the revenues what we have generated from Europe in January and current February, whatever the trends are, they looks to be stabilizing in terms of volumes. And even our revenue is marginally better versus if I compare with the December revenue. So things are stable, but I would still be very little cautious, and we are not very too much optimistic in the short term in Europe, while things are stabilizing and looking a little positive.
Okay, let's focus on the bigger part of your business then, Mr. Bora. Europe is still to come back to life, but you have 89% of your revenues from the India operations. Has there been any kind of slowdown? Is demand, ordering activity as good as what you expected in Q4? And what does this mean for the next couple of years? That's FY25, FY26 as well, on the base that you deliver on FY25.
So we have no reasons to complain in terms of volumes. Things are definitely, we are in a business and business will have ups and downs, but overall things are positive. In fact, if you see full year two-wheeler revenues, two-wheeler volumes are roughly around 9% higher. PV is roughly around 5%. In fact, last month is almost like closer to double digits in terms of volumes. And in terms of the medium term to long term, you spoke about 2 years and beyond. So we are very, very optimistic. And as you know that we are currently having 12 projects or 12 plants under construction. And we have been building some of the lands for our future growth. So we are very, very optimistic in terms of the industry growth. We are roughly 4.5, 5 million PV cars this year. Hopefully, we should grow 2x in next 7-10 years. We are way, way below some of the global benchmarks in terms of vehicle ownership. So we are very optimistic in terms of 2 to 5 year kind of a scenario. Yes, there are some ups and downs, as I said, because of being in business. And as we always say, we continue to maintain our guidance in terms of our performance. So while we don't comment on volumes, whatever industry grows, our goal is clear that we grow at least 1.5 times of industry growth. So if industry in next 5, 7, 10 years grows 2x, we have to see how do we grow 3x in terms of our revenue. So that's where we are, and we are quite optimistic, and we continue to invest in our expansion plans.
Okay, all right. Could you tell us about the EV focus of the business? You know, how much does it contribute? Because that's been growing at a very, very fast clip. And that's definitely going to help you in terms of a kit value as well. So how do you see it panning out from here on?
No, absolutely. So we have been front runners in terms of EV capturing the business for specifically two-wheeler and three-wheeler sector. And if you see the two-wheeler sector, we are almost 2x of the industry penetration in terms of revenue. So industry growth is somewhere around, industry penetration for EV in two-wheelers is somewhere around 6-7%. Whereas of our two-wheeler, the revenue pie is roughly around 13%. So we are almost running at 2x of the industry growth. And that's clearly demonstrating our ability to capture the EV market share. In terms of our kit value, as you rightly mentioned, while the ICE kit value is roughly around 10,000 rupees, our EV kit value is almost 35,000 rupees per vehicle. And that market is still in a developing stage in terms of what gets to outsource, what gets in-house, etc. So we've been working very, very aggressively in that space. In fact, moving to the PV space, as you would have noticed, we have been front runner again in localizing, working to localizing some of the EV components for pass cars. And we have recently converted our TLA to a joint venture with Innovance. And currently we are in the phase of preparing our detailed project reports. And hopefully we should be coming out with the detailed project investment plan, etc. And once we do that, then it will take roughly around 2 years to localize. And as we know that the volumes for four-wheeler are also low. So we are trying to time with the industry penetration as the volumes increase. Our capex also is expected to align with that, and hopefully we should get advantage of the better volumes.
So 2 years before the localization efforts come into fruition. So how should investors look at your margins? You've guided for 11% margins for FY25. Do you think for FY26 it should be similar to 11%? When can margin expansion truly begin for you? How are you thinking about margins and raw materials cost?
So you have to see in two aspects. First, from the margins of RM cost you mentioned. So raw material for us is largely passed through, whether it's up cycle or down cycle. It's all passed through to our customers. We don't tend to benefit or we don't tend to lose on the commodity prices, right? But in terms of your question was on margins in terms of 11% plus minus. So next year we are currently working to see how do we maintain this margin. Specifically, we know that we have 12 projects under construction. As these projects come on stream, you have all the costs coming in. So you have to absorb those costs, whereas the revenue takes maybe 1 or 2 years, 3 years to stabilize and to deliver the target returns. So despite that, we are working to see how do we make sure that we absorb all those costs and still maintain our margin guidance of 11% plus minus 50 basis points.
Mr. Bora, thank you very much for joining in. By the way, the Nifty Bank, that's up close to about 300 odd points, and Innocent Bank, that's managed quite a steep recovery. It's up close to about 5.5%. From the day's low, it's a 14.5% up move on Innocent Bank. The Citi's banking analyst, Kunal Shah, was telling us that Innocent was at 0.6 price to book. So at least from a valuation point of view, it had dropped to significant levels. But other banks, Kotak Mahindra Bank, HDFC Bank, Kotak Bank is up nearly 2%. HDFC Bank has moved up more than 1%. So banks are providing support, and Reliance Industries is in the green.
Okay, all right. So that's the market, at least for the time being. But yeah, the color has slipped. We've not been able to hold on to all that green. Let's go back to Mitesh now for some trading advice and calls. Mitesh, so looking at the volatility early in the morning, what would the course be now?
It's been volatile, but I think, not giving you a clean directional bias. I think just stay put on the index. As I said, I think, buy it if you get it closer to about 22,300, 350 zone, otherwise avoid. And on the stock side, though, we have some buy calls purely because of the fact that a lot of the stocks are, kind of reversing from lower and oversold levels. So Crompton is one name on the list. That's a buy with a stop at about 346 for targets of 365. And a disclaimer, we have recommended Adani Ports to our clients, so there's some vested interest over there. But that's a buy with a stop at 1126 for a target of around 1200.
Okay, all right, got it, Mitesh. Thanks very much for that. With that, we have to slip into a very quick break, come back on the other side, and Manisha will round up the latest from the commodity markets. Welcome back. Well, let's find out what's the latest in the world of commodities, given all of this tariff talk. Manisha is here. Manisha, so what's captivating your imagination now?
Well, my imagination, well, it's somebody else's imagination.
Apart from Donald Trump, what is it that you were able to pinpoint in commodities? Because everything is topsy-turvy, right?
Well, you know, if you look at the global markets right now, all impacts really seem to be coming in from there. But I want to talk about metals right now, and that is because the US dollar index is now trading at a 4-month lows, and that clearly has been supportive for many of these dollar-denominated commodities. And apart from that, it is the chaotic implementation of tariffs that has led to a lot of uncertainty. So from standing now, what we understand is that there is 25% of tariffs on steel and aluminum that goes into effect today. What we also understand is that the 50% tariff on steel and aluminum on Canada does not go into effect today. This is as of now, right now. But apart from that, it also is about the fact that the US and Canada will be holding negotiations over the next 2 or 3 days. So this week, in that sense, is going to be quite important. I want to talk about copper because overnight, we've seen 2.5% of gains in copper. And in Asia right now, we are trading 1% on the higher side. With that, copper is trading very close to its 9-month highs. There also are expectations of a China stimulus hopes, and that has been supportive. And then there also are concerns that China could be, or rather US could be, imposing tariffs on copper going forward. That has been a conversation for 3 weeks now, and the markets are waiting that report. That could be still 10 days away, but that is keeping the street jittery for sure. And then it is also about the kind of premium that copper is commanding in the US markets there. Not just that, when you look at the aluminum and 25% tariffs coming in today, the US physical price premium has hit a record high of $990 a ton. So aluminum is more expensive now in US than anywhere in the world. The street is also looking at the premium prices, which have continued to gain and have gained up by 70% since the start of 2025. Well, Canadian smelters really are the major source of primary and alloyed aluminum exports to US. So 70% of all aluminum alloys that goes out of Canada lands up in US. So that's a big chunk that the markets will be looking at that could be getting disrupted in sense of prices there. Apart from that, it also is about China, where we are looking at a slowdown in production for this year. Last year was a record aluminum production in China at 44 million tons, and China perhaps could be looking to curb that. Well, but apart from that, it is also about the US inflation data that comes in today, and that is going to be a major number ahead of the US Fed meeting, which is on 18th and 19th of March.
All right. Okay, Manisha, thank you very much. We will keep that in mind. We have to take a very quick break. On the other side, our special segment, It's the Economy. Lata today will speak with the head of Credit Bureau, Sybil, on NPAs in retail loans.